Welcome to Investing Confidential. What a rally we're having here. It's the question really is to everyone is how long is this going to last? So we're going to talk a little bit about why this is happening, how long it's going to last. But first, if you like what we're doing, please hit the subscribe button, likes, whatever. New to this whole YouTube thing, do whatever you got to do. But I want to continue doing this, and so give me some incentives. Okay, let's talk about the rally today. Obviously, yesterday we had a big rally. Today we're having a big rally. Overnight, the futures were up massively. I mean, I think I've mentioned before, the markets are illiquid, okay? It doesn't take much to move the markets. But let's talk about some of the reasons why this has happened and why this may continue for a while. Rallies in bear markets are vicious, okay? If you look at the statistics, as I'm showing you here, bear market rallies are more vicious than rallies that come in bull markets. Some of the best rallies, short-term rallies, trading rallies, are during bear markets, not during bull markets. Why? A lot of people get short, a lot of people get negative. Shorts get crushed, people get FOMO, they want to get on, so they just jump on board. They feel they miss things and they're moving in, they jump on. Market was poised to move higher. The bearishness was outrageous, and here's some of the reasons. Put-call ratio was definitely in the favor of the bulls in a sense, meaning there was a lot more bearish people than bullish people. From here you can see the put buying was massive, right? So everybody was getting bearish. Everyone was trying to get protection, and this is why they buy puts, for protection or what have you. Some more evidence was call buying, right? Nobody's bullish, right? The call buying, as you can see here, was pathetic. There was nobody buying calls. So again, washed out. Fund bearishness. Look at here. The institutional funds were very, very bearishly positioned. Again, another reason to think that we were on the precipice of some kind of what we call a counter trend rally. Cash levels by these institutions. So their position bearishness with their positions, with their stocks, and then they had massive amounts of cash, historically high levels of cash versus the past, again, setting up a potential rally. They were also selling stocks, right? Institutions have been net sellers of stock, and they've been selling pretty rapidly, again, reducing their exposure, again, a contrary indicator. So you look at short positions, everybody's short, okay? This is more evidence that people were bearish. A lot of people were net short, and this obviously is again setting up. This is one of the major, gasoline on the fire to this rally, with people being so net short. Hedge fund leverage, very low. That means hedge fund had very little exposure. They took the risk off the table. Hedge funds are usually sort of the head of the game here. They're not the smart money anymore, but certainly it's good to see what they're doing. And when their leverage is low, meaning their leverage, meaning exposure to the markets are low, that's usually another contrary indicator. Another indicator is the volume. Volume is very light. As I mentioned before, the markets are illiquid anyway, but when you have really light volume, corresponding with this low liquidity, which I think is going to be here for a very long time, maybe forever, meaning between the hours of 10 a.m. and 3:45 p.m., there's just no liquidity. The institutions come in the beginning and then market on close. That's where all the volume is, okay? You can look at the chart of the New York Stock Exchange and they will prove to you. So during the day, you should be stepping away from your screens and doing research and talking with companies rather than trying to trade, because it's just insane, the volatility. And finally, risk levels, they're just very low. No one was taking risk. And then this is leading to what we have today, which is this massive last 2 days, big rallies. Could this continue? Sure, this could continue for a while. I don't know how long. But as I said before, these rallies are to be sold or to get out of positions, not to just jump in, unless you're a very aggressive trader, and then obviously you can take advantage of these rallies as a day trader, etc. But let's talk about why this is not going to last. And the reason it's not going to last is just the environment we're in. Look at these 10-year rates. They have gone up. This is the largest move in yield of 10-year rates since 1978. Unprecedented, right? So we're in a situation we haven't seen in 30 plus years. So to think a bull market's going to start or this is a short bear market or a correction is foolish, because we have not seen this kind of movement in interest rates for a long time. And remember, the bull market in equity started in the early to mid 80s when rates started to come down. We have had a bull market in bonds for 30 plus years, corresponded with a bull market in stocks. The stock market bull market did end in 2008, 2009, but again started again and again, driven by the race to zero with interest rates. And then this bull market we've had since 2009 has been maybe the greatest bull market ever in terms of movement higher. Again, yields. Here's a terminal rate. We talked about this 2 weeks ago. Terminal rate, the talking heads were talking 3.5, 4. We're now at 5. We're probably going to 6, given what the Fed is supposed to do and what they're going to do. We're probably going to 6 on a terminal rate. That's going to be devastating. I mean, quite frankly, this economy is in recession. It's going to recession no matter what anybody says. So just look at these terminal rates, how they've gone up in just a couple of weeks period to this 5% level. But the real issue here, again, you can't look at this in a U.S.-centric level. You have to look at it in a global standpoint. Europe is in big trouble. Look at the CPI. They've got a really big inflation problem, much bigger than ours, because theirs is much more sticky than ours is. It's affecting their GDP. Look at the German GDP levels. I mean, this is supposedly the strongest economy in the European Union, and it's got major issues, right? You definitely have a stagflation situation in Europe. There's no doubt they're in recession. They've got high CPI, high inflation. They're in stagflation, and they've got big problems. And this is combined as a unit and as a whole, the largest economy in the world, right? So the U.S. likes to think they're the largest, yes, but if you take the EU as one, this is the largest economy. So if you combine that with China, which we'll talk about, I mean, this is a disaster for any company doing business overseas. And here's something that you have to look at. Okay, this is, I would say, one of the most important charts here. Europe's trade deficit. Why do I mention that? It is at dangerous level. Bottom line is this. The trade deficit, this kind of trade deficit was the trigger for the 1987 October crash, where the U.S. market went down 22% in one day. Okay, it was triggered by a trade deficit number. These numbers are very dangerous. It shows how weak economies are. We could get that situation in Europe, which could trigger, contagion around. So this is something I think no one's talking about, but you have to pay attention to this. The trade deficits around the world, specifically in Europe, at our red flag dangerous levels and not to be ignored. The global economy, consequently, is really reeling right now. China itself, we talked about China in the past. Their real estate market is destroyed. Okay, look at the situation with the real estate developers. They're building houses. They're not finishing them. There's no interest. People are defaulting on their mortgage loans. China is trying to prime the pump. They will eventually, but it's not working right now. And one of the reasons not working is this zero COVID policy. Look at here. This thing is not working. Okay, people thought that China's controlling the COVID, whatever. No, they're not controlling COVID internally, because they've already, they're locking down. They've got big problems in Shanghai and other places. Beijing, you don't read about this, but there are large sections of Beijing that every other week are being locked down. Again, we talked about this the last video about China. They have these apps. If you're in a lockdown area, and you could have literally 50 million people in a lockdown area, if you're not testing every day and log in your app, you will get a knock on the door by the police. Okay, end of story. That's a fact. Okay, this is out of control. Therefore, the bottom line is it's really affecting their economy, and there's no end in sight, because we all know that COVID is going to be here. You have to accept it, and that's it. It's a cold, whatever it is. You take your vaccines, whatever you want to do. But the bottom line is it's not going away. And any country with a zero COVID policy is really doomed, and China is doomed. Look at their equity market. You've had a 20 plus year bull market, much longer than ours. Okay, our last bull market here was in 2009. They've been on a bull market for 20 plus years. It's broken. Okay, long-term support's broken. The Chinese economy, again, if you believe stock market's a leading indicator, I question that a little bit, but if you believe stock market's a leading indicator, certainly, breaking a 20-year bull market is really of a big concern for global investors and economists in general. So how does this affect the U.S.? Well, look at some of these indicators in the U.S. U.S. Empire Manufacturing, expected shipments. I mean, this is a disaster. This is one of the main indicators that a lot of economists use, leading indicators. This is not good. This is not good, and it's going to contribute to what is a recession here. And you look at earnings leading into recession. This is another indicator. You just look at this chart, read a little bit. We are headed there. We're already in a recession. I mean, you can play games about it, but we are already in a recession, and we're going to continue to be in a recession for quite some time. It's going to be a longer recession than normal. So this whole GDP now nonsense. Most economists worth their salt are looking at 0.5. If there's growth, it'll be 0.5%. It's not going to be 2.8% that the government's going to push on you. So don't believe anything you see. We are in a recession. We are heading to a longer recession. It's going to be here for a long period of time. Okay, what does that all mean? At the end of the day, what that means is the Fed is going to pivot at some point. Not going to pivot anytime soon because the Fed is so far behind the curve. They're going to continue to raise rates. We're going to go 75 to 100, most likely 100, and then another one. And so we're going to see the Fed continue to raise rates through the first quarter of next year. They have no choice. Inflation is sticky. Okay, as I said before, it has peaked, but it continues to be sticky. The Fed has a target of 2%. There's zero chance of that happening anytime soon. But you could see with this economy and the rest of the world going into recession, a global recession, you could see inflation come down to, let's say, 4%, 4 or 5%. And then you're going to see the Fed pivot. I don't know the timing of it, but that's what I would look at for a Fed pivot, is about 4% inflation rate. Then you could know that the Fed's probably going to stop. They're not going to cut rates, but they're going to stop. But it doesn't matter. At that point, you're going to see a big rally. But again, as we said, in this time period, whatever rally we get in the future needs to be sold because the damage will have been done. Here, long-term, China is going to continue to export deflation. Okay, this is going to, so people are worried about inflation. Okay, inflation is a disaster, but long-term, and I'm only going to mention this now because in the short term, it's not going to matter, but long-term deflation will extend the recession for a very long period of time because at the end of the day, the Fed tools don't work. This QE never worked. Bring your rates down doesn't work. All it's going to do is create another asset bubble, but it's not going to help the economy. So enjoy the rally while you have it. Who knows how it's going to last? If you're a momentum player, this is wonderful. You're going to use charts, but at the end of the day, we are in big trouble economically, globally, and just remember that. So if you're an investor, as always, be careful out there.